Hello, how are you? So in today's video, as you can see, the title is McDonald's, the McDonald's company, where every parents who has a young kids or at your school time must have gone many times to McDonald's. The ticker is MCD. So I think so today I will try to do the stock valuation. So basically this is my agenda. I'll compare the company performance and then see the total returns for the 10 years, but the company performance pretty much as compared to S&P, then see how the company is doing at the time of coronavirus. Is the company is doing any share purchase? Does the health check by looking at the liquidity, and then also cover these do the stock valuation, basically compare the intrinsic value of the stock using the net profit model, enterprise value model, and the free cash flow model. And once I have everything, then we'll try to see if is a good as a long-term investment or we can just bypass that. So that's what's the intrinsic sorry interesting video. And please give a thumbs up and subscribe if you are new to the channel, and do check my channels for some other stock valuations. So without further delay, let's get started. Let me put myself on hide so I won't cut by mistake anything. Okay. So if I see the MCD, the ticker name is for the McDonald's for the performance as compared with the Dow Jones Industrial Return and the S&P 500 index, the company does pretty very well in terms of the if you for as a 5-year comparison, right? So right now as of the 31st, not now, but as the annual 31st December, the stock was at $242. Basically, if that's a return it's showing if you reinvest the dividend. So that's what they meant by the cumulative 5-year total return. So it does pretty well. So that's from one perspective. Similarly, if I see from the I plot the 10-year of the data, and I'm here showing the return on investment capital, right? The return basically based on our investment, right, which is running, and also on the assets. If I've It's very interesting, right, and it's very good. So the return on investment capital was 20.28% in 2010 December, and now it's standing around now December 31st. It's when I see is almost 33%. So very good in terms of the annual returns, right? It was quite a dip, and then it jumps in 5 years ago, and then it's doing very well. Similarly, on the return on assets is especially for this restaurant industry that's what its stand is. Quick food is also very good, right? It's double digit, so it's keep maintaining around 15. It's dropped a little bit in 2015, but then it come back, and then now it's dropping again. But overall it's good. It's double digit return on assets, so that's very good. I really like it. This thing I really want to show it to you. That's very amazing because this is a food business, right? So food take a lot of it has a huge cost, but look at it, right? So before they have a gross profit margin in 12 is around 40%, right? But they shrink the cost of goods sold, and now it's over is 51% stands. This is amazing. I really like how they able to control the cost of goods sold to come up with this. So this means the cost of goods sold is only 49% as compared to almost 60% in the past, right? So this is amazing. Okay, so now let's compare the sales. This is the recent income statement. I'll just go quickly over it, and because I'm in my models, I'm using the 10 years of data. So this is just to see how bad the company has does in the times of the coronavirus. If I compare the company, this is the quarterly statement available end of the 30th June, right? The third quarter. So the revenue basically it's declined 34%, right? The top level 30% decline as compared to the last year, right? If I does that, this is the dollar terms, and this is the increase and decrease in terms of the revenue. If I just quickly go to the bottom line, which is the net income, this is almost 70%, and same thing on the earning per share. It was 1.97, now is only 0.65, which, because the main thing is these are the brick and mortar stores, right? If the shops are closed, everything closed, then for sure these kind of business get impacted. Okay, let's continue. Okay, in terms of their global, I also want to see from the global operations, right? Because their sales are three categories, right? One is the US, then is international operated. You can see the description here, and then through some licensing, which they do all other geographical regions, including Latin America, right? So good thing about what I really like about here is this is for this year from April, right, when the lockdown was literally started in during the US and Canada and all, right. And at least in Canada I can see because we have a kid as well, and you cannot just go and buy the McDonald's because it's all closed. Okay, so the US, you can see the April 30 is 20% decline, and then it's only 5%, and then it's 2%. Seems like the overall is a decline in terms of the negative, right? So which is a good sign. Similarly, on the international side and also on the licensed developed market, where is the Latin America and other like China and Japan, it suffers a lot or pretty much stale as compared to May and June. But overall, we see the decline pattern. And this is, you can look here, it's all positive, but for sure it makes sense. If I just do quarter ended based on this geographical region, it's negative. Okay, this is a very good another good point. I like it and I like to share. So the idea is here is not only just to see from quantitative perspective to just come up with a number, but also to see how we can see from the revenue perspective or the management perspective, the share purchase perspective, dividend perspective, and all actually from the qualitative perspective as well, to form the opinion. Because value a security, from my perspective, on what I learned from the legends like Warren Buffett and others, that this is both the art and the science, right? So we cannot just have a science component, we all need some art component as well. So that's why when I try to pitch the video or try to make these video, I try to see from all the perspective, and then try to put in the slide, which takes a lot of time to come up with the slides, and then the present the deck, and which is important to in the finite period of time, right? Okay, so as you can see, they did a fair amount of share repurchase. But this thing I really like to highlight here, right? In December 2000, okay, now from here, effective January 1, the board authorized the purchase of 15 billion shares of the company with no specified expiry date, right? So now the company has that much of the power, because board authorized, they can go there and buy the share, right? So, and pretty much if we can see here from this, the number of share repurchased, right? These are in millions, right? 31 million, 32 and 25 million shares. So not only the dividend, we can see here as well, the dividend the company is declared, but they are also doing the share repurchase. So so we are getting from the two side, right? As a shareholder or the investor in the company, which is a very good, right? I really like they give back to the shareholders. So this is another checkpoint. I'll make it. And so far, if you haven't give a thumbs up to the video or subscribe, I really appreciate. And if you give a thumbs up, so more and more thumbs up will help to pop up this video, and it motivates me as well if I see the subscriptions coming higher, and honestly the thumbs up. Okay, so let me go back, and okay, what is next? This is on the liquidity check. Looks like a kind of a wave, right? But anything above 1 is very good, and I see is in 2014-15 is way above 1. If you don't know what is this, basically it's on the short-term liquidity, right? So how much the McDonald's has the assets as compared to their liabilities, right? I made a video on my channel as well. If you don't understand all those ratios, just go and look into it. It's very detailed, and I also have some on the profit side as well. The income statement, those ratios. So is over 1, just take a word for it now, it's good. Okay, now let's go to the model and see the pricing. Hi. So I will go into the 3 models to come up with the stock value, net profit, enterprise value model, and the free cash flow model. So in each model, I have taken the 10 years of data, and then I have shown the 10-year, the CAGR, and the 5-year CAGR. Basically, these are the annual growth rate. So the revenue, although the revenue growth rate is not that much, but we have seen, because of the optimizations of the statements, income statements, or other, the net profit margins is increased, right? If you can see from the past 10 years, the last 5 years is 5.87%, which is very, very good, honestly, right? And where when they're selling the cheap value, but the margins are still able to maintain the margin, so that's very good. Okay, so again, so here as usual, I take the required return of 10, and although the current PE is way high right now, it's 32, and basically it's a little is less over the industry PE, but still I'll just keep the S&P 500 PE just to be a little bit safe side. I believe right now the industry and the current PE doesn't reflect good. So from here, I'd project the 10-year of the net profit, the net profit for 10 years, and decline the growth rate from 5.87% to 2%, and then just discount the net profit for the 10 years to the present value. When I sum all the present value, I come up with the $122 billion of the market cap. Right now, the share outstanding is 744 million. If I divide it, I got from first model $164. Okay, let's go to the second model. Second model, we have the enterprise value of 101 billion dollars to 273. And basically, let's look closely into the EBITDA. EBITDA is basically getting worse. If you can see, is 25, right? Why so? Because I can see here very nice, easily that all the enterprise value is growing, but the EBITDA is not grown as much. It's only double, right? It's good. It's from 2 to 4%, but basically the debt is grown a lot, right? So that's not good. So anything above 15 I consider is pretty bad. It takes, and now it's 25 is not that great. If I see the average EBITDA is 16, 17, so you can see here, right, it's over average right now, so it's not that good. The total debt is increased a lot from 1.32 to 3.18, but the good thing is in the last 5 year, right, the debt ratio, the year-over-year growth is reduced as compared to the historical 10-day annual growth rate. So that's a good thing. They're not raising more debts. Okay, so here I have taken the grown the EBITDA, project the EBITDA for the next 10 years, and then grow from 4.2 and drop the growth rate to 2% the same way, and then take the present value. The total market value I got by adjusting the debt and average cash is $151 billion company. When I adjust it to divide by the number of shares, I got my value as $203. Basically just right. This divided by this simply $203. So that's from my second model output. Let's go to the last model, which is free cash flow model. So the free cash flow model for for 10 years, I have come up with the operating cash flow, then adjust the capital expenditure, and pretty much just sum it, right? Nothing much fancy here, if you can see. And then these are the price. So the free cash flow yield, basically, as you can see, it's reduced from 7.36% to 3.8, almost half, which, right? and the average free cash flow yield stands for the 10-year is 4%. Okay, for the last 10, which is reduced, which is not a good sign. So basically every price, whatever you're saying, you only get free cash flow 4% of for that price, right? Okay, again here I'm growing at 3.93% the free cash flow and dropping it to 2%, right? Every year I'm based on the method, interpolation method, I'm just reduce some cash flow. And then I have this time I have taken the 4% average price to average cash yield to come up with $191 billion. So with the free cash flow, I come up with the company value of only $109 billion in terms of the today's value, right? When I divide this by number of share, I got it $146.86. So this should be the price. So I have 3 models. Okay, now I have forgot to hide. With 3 models, I got my price of $171. As you can see, I almost equally weighted each model, and these are the price. And you just sum up these price. This is and right now in the market, the price is $204.60, right? So now the price in the market is is overvalued, I believe, as per my pricing, which comes out from this model. I was a little bit conservative, but better be conservative rather than sorry, right? So that's what my take on it. So we have seen in this one we have seen that the company is giving dividends, increase the dividends. Company doing this, have the 15 billion allocation for share repurchase. We don't have to forget that. Gross profit margin is increasing. The company is coming back when on the full scale, when the economies open up again. The whole world is a global brand. Kids are crazy about it. That's no doubt, and they are doing some good thing, but it's still a junk food and all, right? So from that perspective, you need to think. So do you think from this, right now the stock is overvalued, do you think you want to add this in your portfolio or not? Please do put in the comments, and really appreciate if you can give a thumbs up to this video and put a subscribe if you're new to the channel. So myself, Pramod, I'm a CFA charter holder, and until for the next video, see you, and thank you a lot to spending the time with me to watching this video, and bye for now.